Hi, everyone. Thanks so much for joining us today. Welcome to KLG's first ever webinar. My name is Samantha Brennan. I'm the Director of Business Development here at KLG, and I'm also the moderator for today's webinar. Before I pass things off to today's speakers, I just have two quick announcements. Firstly, at the end of the presentation, you'll be asked to answer a few feedback questions. We understand that your time is valuable, so we've kept them short and to the point. We just ask that you please take a minute of your time to answer the questions. And secondly, we thought it'd be fun to get into the spirit of the Super Bowl and take a poll to see who's rooting for who this weekend. Our speakers are going to be sharing that poll with you now. And with that being said, I'm going to pass things off to you and hope you enjoy.
Live from Allegiant Field in Las Vegas, Nevada, home of Super Bowl 58, it's David Gralnick and
Panariello.
presenting Navigating and Understanding Personal and Business Tax Returns for Attorneys.
Okay. We'll get started. Just a couple of disclaimers here. Everyone can take a second to read it. Just advising that this isn't intended to provide any legal or tax advice. We're going through some general concepts of tax returns. Okay. So let's get started. So throughout this presentation, we're going to go through several different tax forms. The first one that we're going to go through is Form 1040. That's a U.S. individual income tax return. So right up at the top of the Form 1040 is some general information about the tax return. Who is the tax return filed for? The first name, last name, social security number, if there's a spouse involved, which typically you would think that we would always see that, except if you look at the next section, filing status, if this is a tax return that is denoted, and I'll highlight it here with my laser pointer, is denoted as married filing separately, which is this option right here. And I'll zoom back in. Then that person's going to have their own tax return to file. So right up at the front of the tax return, it's important to look at this first, because you want to know whose income are we looking at, whose assets are we looking at when we're looking at this particular Form 1040. Another section at the top that we like to look at is the new section called digital assets. If you're looking at tax returns from 2019 and prior, I apologize, everybody. Okay. Let me unzoom this. I apologize for that. We weren't sharing our screen. This is the Form 1040 page 1 that I was just talking about. And we started with the top part of the 1040 that has the individual's name and their filing status. The next section that I was just referring to is the digital assets section. So digital assets are an ever-growing topic of discussion, right? Cryptocurrency and other digital assets. They were once considered the Wild West of investing. They're still, from a risk perspective, the Wild West of investing, but the IRS has definitely become more sophisticated on tax reporting for digital assets. So in 2020, the IRS introduced this section to the Form 1040, where a taxpayer is going to indicate if they received or sold any digital assets or a financial interest in a digital asset. One thing that's important to note here is the nomenclature, insofar as that it is indicating if it's received, not purchased. So if anyone went on their Coinbase account and purchased Bitcoin, that's not going to fall under this category. If somebody did some work for someone and they were compensated in the form of Bitcoin, that's what this section is intended to indicate. And also, if that same Bitcoin was sold, you would check off the yes box. Now, just because the box here denoted as no, if that's checked off, that doesn't necessarily mean that there's no digital assets owned by this particular taxpayer. It just means that this particular activity didn't apply to them during the year. Now I'm just going to slide down a little bit. So the next section of the first page of the Form 1040 is the income section. There's some key lines that we'll point out, and we'll get into more detail as we look at the specific schedules related to these lines as we go through our presentation. The first line is line 1A, and that's going to be where W-2 wages are reported. It's important to note that this is a catch-all number. So if a person, if a taxpayer is reporting with their spouse and they each have a W-2, those are going to be put together and reported on line 1A.
And at the back of the return somewhere, there'll probably be a schedule that breaks it down by which W-2, by W-2.
Exactly. There's a lot of information that gets reported in between. We're going to stick, due to time, to the most commonly reportable items. So the next one would be tax exempt and taxable interest. That's going to be on line 2A. This is going to be any interest from interest-bearing accounts, such as savings accounts or interest on investments through a brokerage account. The detail to that is going to be reported on Schedule B, which we'll get to in a little bit. The next line is line 3A for qualified and ordinary dividends. Again, summary numbers. The detail to that also gets reported on Schedule B, but those are going to be dividends that are paid to the taxpayer through their investments in a brokerage account, or if they have an investment in a C corporation, which has paid them a dividend. The next line to turn your attention to would be line 7. That's for capital gains or losses. That's on sales of property, such as real estate or stock in a brokerage account. Any gains or losses from those transactions are going to be reported on Schedule D. The limitation on losses for this section is $3,000 for is that an individual?
That's married, filing joint, or a single taxpayer. If it's married separate, it's $1,500.
Exactly. And the rest of the income is actually, if you look at line 8 here, and this is very typical of tax returns, they point you to different schedules and different lines. It's really a roadmap. So line 8 here actually tells you for additional income, go to Schedule 1, line 10. So let's go over to that now.
Before we go, can you go back for a second? I just want to point out, sorry, if you go look at lines 4, 5, and 6. There you go. So if in lines 4, 5, and 6, you have 2 different boxes. What's the full amount they received, or what's the taxable amount? So if you're looking to figure out what their true income is for purposes of your net worth statement, you're going to want to look at 4A, B, and 4A, 5A, and 6A for taxable numbers, because there are limitations and other things. You're going to look at 4B, 5B, and 6B. There'll be a couple of exemptions to that. IRA rollovers would fall into an IRA distribution under 4A, but wouldn't be taxable, but it's not really income to them. It's just moving it from one account to another.
So Schedule 1 is going to give you a couple of more important line items as far as income is concerned. So the first one I would like to turn your attention to is line 3. This is for business income from a sole proprietorship or a single member LLC. That gets filed on an attached Schedule C. So we'll get more into detail on that, but that's essentially a business that the taxpayer owns by themselves, and a separate business tax return is not required to be filed. And therefore, all of the income information is reported directly on Form 1040, which is on the Schedule C. The next item is line 5, which is rental real estate and also income from partnerships and S corporations, that's going to be your income from two different sources here. The first one is rental real estate, which is if you own property and you're receiving rental income, offsetting that with expenses. The second component of Schedule E is reporting income from pass-through entities. So that's partnerships and S corporations. And we'll get into those tax returns in a little bit, and you'll see how the income from those entities are reported on a Schedule K1, which comes back to Schedule E on Form 1040. And the last item I'm going to put here is under Section 8, which is other income, and it's specifically line item A, which is net operating loss. So this is showing what the net operating loss for this current year being applied against taxable income is. The reason why this is important is because if a taxpayer is carrying a net operating loss forward, that's going to create a tax savings in the future for that person and potentially should be considered a marital asset if applicable.
Couple of others I like to point out: 8B, gambling, and also cancellation of debt. If someone had their debt canceled, that'll go into 8C. Prizes and awards, anyone's ever been on Jeopardy or any of those and won, that'll actually is taxable and would go on line 8I. 8I. So let's move on to the next slide, which is page 2 of the 1040. And we'll zoom in on that as well. Okay, so at the top, it's going to tell you how much tax, and that's figured out from the tax program and everything. Your total tax goes on line 24. Then it's going to show what payments were made, and it shows if it comes from Form W-2, which would go into 25A. If you get a 1099 and it has tax withheld, that would go to 29B. Not often we see 25C, and then we'll have other things like estimates, tax payments, which would go on line 26. All those get added up, along with some credits here to go to line 32, which would be total payments. And then you just subtract the tax from the payments, and you get either your tax due or your overpayment. So if you go to line 37, that would show what your tax due is. But if you go to line 34, and this is important, shows refund. If there's a refund, that's a marital asset if they're filing, if it's prior to date of commencement, okay? Or if marital monies were used to pay the tax. Part of that could be refunded to you, and it'll show line 35A what account it's going into. Or they could get a check, one or the other, okay, if they're not going to directly deposit. And then there's another line on line 36, which is applied to your 2024, because we're looking at 23 return, estimated tax. In that case, okay, you're going to have to take this amount as the asset, because that's what's also applied to next year. And if they're not going to file a joint return next year, that's somebody's asset. Okay, and then it just gives, some basic information on who the paid preparer was. If you have an accountant, all that information is going to go here, and that's important for purposes of, you knowing who the accountant is. We have the sign here as well. A lot of times now we get the electronic signature, so this isn't necessarily filled out. This is for people who actually sign and send, and that's few and far between now. So that's page 2 of the tax return. Okay, then we have Schedule A. Schedule A is your itemized deductions, and not everybody itemizes their deductions. In New York, we tend to, because our taxes are fairly high, and we have, if you own a home, you have mortgage interest. But you put in the medical. This is still subject to 7.5% of your AGI. So you have to anything that's deductible has to be more than 7.5% of your AGI. So if you have $100,000 of income, you have to have more than $7,500 of medical expenses before you get $1 towards that itemized deduction. Then you have your state and local taxes and your real estate taxes in here. As we all know now, this is subject to a $10,000 limit. You know, that may or may not go back away in a few years. When the sunset provisions go in, we'll have to wait and see. But for now, your state taxes and your real estate taxes are all limited to $10,000. Doesn't help us in New York. Then you have your interest on your home mortgage, which would go in here, and any other, interest on mortgages, and, you've got your points as well would go here. That gets added up. You have your charity. All of these you may want to check. So if somebody says they have a mortgage and they're not on their net worth statement and they're not deducting mortgage interest, you would have a question there. People put on their expenses, they have $20,000 in charity, and here they're only putting, $10,000. Again, something when you're filling out net worths, you might want to refer to these schedules on your expenses and make sure it kind of all ties out. And then, these are just few and far between things, casualty and theft loss. Other deductions don't really exist anymore. They're very, very rare. Then you have a total, and there's a small little percentage that are disallowed. So that's your Schedule A, and this would go back to form the Form 1040, page 1, when you're figuring out the total income, your total taxable income.
The next schedule on the Form 1040 that we'll discuss is Schedule B, and this one's actually really important. Schedule B is what I mentioned earlier. Page 1, here we go. Page 1 is going to present the summary numbers for interest income and dividend income. Schedule B is where you're going to want to go to get that detail. And this is really important because here is, a requirement to report institutions, bank account numbers, brokerage account numbers, down in the ordinary dividend section. If there's any C corporation dividends, you have to report the name of the entity that you're receiving dividends from. And this is a schedule that we rely on a lot as forensic accountants. And it's a very easy thing to cross-reference. But one of the first things we do when we receive a statement of net worth from the parties is to go to Schedule B and make sure that every bank account or brokerage account for which there is interest income being reported, make sure that that is on the statement of net worth. The third section at the bottom of Schedule B is foreign accounts and trusts. Now, there's no numbers that go into these lines 7A, 7B, and 8 down at the bottom here. But what these do give you an indication is if the taxpayer had to fill out Form 114. So Form 114 or 114, it's required by FinCEN, which is the Financial Crimes Enforcement Network. And what this does, this has a threshold of $10,000. And what it means is that if the taxpayer has $10,000 or more of foreign assets, they have to prepare Form 114. Now, interestingly enough, Form 114 isn't issued by the IRS. It's issued by FinCEN, which is another government bureau. So there's no requirement for the taxpayer to actually attach Form 114. However, the taxpayer is required to notify the IRS whether or not they have actually filled out that form. Now, this is a good place to look to if you have a client who is indicating they think that their spouse has foreign assets, they're hiding things overseas. Another form within the 1040 that you can look at is this next one here, Form 8938. So I'll zoom in a little bit here. Okay, so the top part of Form 8938 is a lot of repeat information from page 1. As you go down the page, you'll see this section, Part 3, where the taxpayer has to disclose any income from foreign assets. Now, this isn't an end-all be-all statement, and that's because the thresholds are relatively high. If The only reason you would report Form 8938 is if you ended the year with $100,000 of foreign assets. Or if at any point during the year, those foreign assets get as high as $150,000. If the foreign assets never approach those levels, then Form 8938 isn't required. But the second page of Form 8938, if it is filled out, is also very informative. And I'm just going to blow that up here because the taxpayer has to disclose actual specific information, bank accounts, what type of accounts they are, account numbers, balances in those accounts, and that's in part 5. And then in part 6, they'll have to give more detailed information about what they call other foreign assets, and that's a bit of a catch-all. It could be an interest in a partnership, a corporation, a trust, an estate that's in a foreign entity, all reported on Form 8938.
Okay, so the next form we have is Schedule C. And this is for someone who owns their own business, either as a sole proprietor or a single member LLC, which would eventually go to Schedule C. And this has the name of the person, the name of the business. There's a code here, either your social security code or your EIN number, and what's like your NAICS code to fill in, what method of accounting you use, either the cash or accrual, and some other miscellaneous questions. Then part 1 is your receipts, your income, your sales goes here. And in part 2, you have all of your expenses. So you have advertising and your car and your depreciation and your salaries that you pay other people and your rent. And then there's other expenses, which will go to the second page of this form. And what you're trying to do here, when you look at this form, is to obviously determine somebody's profit and loss that they're reporting from their Schedule C. So, this is going to be income. If you're trying to get cash flow, depreciation is going to come into effect. It may or may not equal what their capital expenditures are. So you may want to take that into account as well. This will also tell you if there's a mortgage, if they're renting property, you'll know that you could ask for a lease on that. So all of these things are interesting tidbits that you can use when trying to get information with regard to their Schedule C. And then, everything comes down to the final line, which just reports the total amount that would go to, at the end of the day, Schedule 1, which then goes to page 1 of the tax return.
Before you move to the next slide, I just want to indicate, because this is on a personal tax return, so a lot of times it gets a little confusing when you see expenses on a personal tax return. But it's important to denote that this section, part 2 on a Schedule C, it's not for all of the taxpayer's expenses. It's only for the business-related expenses. So if you're trying to compare, a statement of net worth expense section with part 2 of this Schedule C, it's not meant to tie out, and it's not going to tie out. These are strictly business expenses, not the party's totality of expenses.
Well, and in fact, nothing on here if it's deducted, because the business expense should be on the personal net worth statement anyway.
Exactly.
Okay. Schedule D, capital gains and losses. So here there's 2 different sides to this. You have the short term, which goes up top, and the long term, which goes down below. Now there are certain here, there's A, B, and C, which are different things. Is it reported to the IRS on a 1099? Is it not reported? Do we not know the information? Then you total your short-term gains, and then we add the short-term gains from K1s and from your partnerships, S corps, your states, your trusts. All of that goes in. Then if you have a capital loss carry forward, a short-term one from the prior year, that goes to 6. And I'll show you where you would find that out in a minute. And then your total net short-term gain goes to 7. And then what we do is we go through the same exercise for long-term, And then we add stuff that goes on Form 4797, which again is going to be from the, disposition of assets. And then you have K1s. Then you have capital gain distributions, which would be on a Form 1099. So if you get like a dividend, sometimes a dividend is a capital gain distribution, not a dividend. So it would go here because it's taxed at a different rate. Then you have the capital loss carry forward from the prior year on the long term to figure out what your total capital gain or loss long term is. And then what happens is you take it to page 2, and at the top here, you'll have your combined long term and short term. Now, if this is a negative, okay, that means you have a capital loss carry forward to bring to the next year. So when I was saying, if you looked at the capital loss on the prior page, if you saw a capital loss carry forward, that means the prior year would have had a negative, and they would have taken out a maximum of $3,000 for single or married filing joint, or $1,500 for married separate on your capital losses on page 1. And here it'll break it down and give you, if you've taken the $3,000 or the $1,500 here, line 21, and then you'll have whatever this number is minus that is your capital loss carry forward to the next year. And again, that could be an asset. That could be something that's an asset of, marital asset. It could be. So you want to remember that. You want to look for those things so you know what what are the assets and liabilities of the parties.
Okay, so an attachment to Schedule D is Form 8949. So when Dave was showing you those different buckets of short-term and long-term capital gains, whether it's bucket A, B, or C, whatever bucket it goes into, this Form 8949 is going to provide the detail for those numbers. Okay, so it's just going through some of the columns here. It's going to give you the description of the property. So if you sold Apple stock, it's going to say Apple stock. If you sold Amazon stock, it'll say Amazon stock. The date acquired is going to be, that's pretty self-explanatory, the day in which it was purchased. The date sold, again, the day in which that investment was liquidated. The proceeds represent the actual cash that was received. And that's an important thing to differentiate between Schedule D gain and loss versus actual cash flow if you're trying to trace the amounts of proceeds that came from the sale of property, such as stock or real estate. Column D here actually presents the real cash flow. Column E is the cost basis. So how much was that particular asset originally purchased for? And then the rest of the math will give you the gain and the loss in column H. What's important about this schedule, we talked about digital assets and cryptocurrency early on, and how in 2020, the IRS put that first box onto page 1 of the Form 1040. Going back to 2014, the IRS started considering cryptocurrency as quote unquote property. And property is the same classification that's given to stock, real property. So anytime you sell those things, it has to go on this Form 8949. Well, now it's the same thing with cryptocurrency. So you can look at this and actually see Bitcoin or Ethereum or whatever is being sold. Now, why is this important? Because a lot of times, and still, cryptocurrency, it's a tough thing to trace. And there's claims of, my husband owns Bitcoin, my wife owns Ethereum, and how do we trace this stuff? Now, what we're looking at is a schedule of things that are sold, right? And that doesn't always help you to identify what exists today. But what you could do is use some of the context clues that are on, this schedule to identify any other assets. So as an example, if there's a sale here of Bitcoin and the date acquired is 2014, and it says that the cost basis in column E here is $50,000. We know we're looking for sometime in 2018, or it should be even more specific as to the date, when that was acquired, right? And then if you go back to the actual bank statements where you do have a paper trail, and you go and you see a transfer over to a Coinbase account of, $100,000, you know that you're missing a $50,000 piece of cryptocurrency that's still out there in the world to find, or at least to ask the questions about. So, this Form 8949 has a lot of information, but if you read between the lines, there's even more information as far as uncovering assets.
Okay, if anybody has any questions, by the way, you can just type them into the Q&A and Samantha will pass them on to us. So Form 1040 Schedule E. This is the first page of it where you would have rental real estate. So you have three different columns for three different properties. If you have more properties, you have to file more Schedule E page ones. Okay, and then it tells you the type of realty. Is it commercial? Is it residential? Single family, multifamily? Is it a vacation house? All of that. Then you have rents received. That's the rent that they received, obviously, the money they have, and these are their expenses against it. And again, here's your depreciation. So, that's when you're looking at income versus cash flow, that's one of those things that you're going to look at. So if somebody says they have a rental real estate on their net worth statement, you want to look to Schedule E, see if they're actually reporting the income and expenses from that. And then page 2 is where you would find your businesses. So your income or loss from partnerships and S corps go on this top 28. Okay, you have 4 different lines. If there's going to be more of them, you're going to see schedule, and it'll tell you the name. It tells you if there's income or loss. It gives you the employer ID number. And down here, if it's passive income, if it's non-passive income, non-passive loss, all of those things go into it. Then as we move further down, we have estates and trusts. So if someone has an interest in an estate or a trust, then that information, if they have any income from it, will also go on the tax return. And then it's all summarized here. And it then goes to page 1 of the tax return. Now this summary, okay, will also include stuff from the first page of it. So when you down here, okay, you would have here, and then you would add all of these together. And at the end of the day, you're going to have your total, which goes to page 1. So you're not looking for 2 different numbers on page 1. It totals itself together, and then it's transferred to page 1.
Okay, that concludes the portion about the Form 1040 personal tax return. We're going to go through a couple of the pass-through entities, so that's S corporation and partnerships. We're going to go through a couple of those tax returns. So for S corporations, they file what's called Form 1120S. So what we're looking at here is page 1 of Form 1120S. So a few things to pick up right in the beginning is the name of the entity, which we've whited out for confidentiality purposes, of course. That would go right in the middle on the top of the tax return. Also the business address. Over on the right side in box E, it's date incorporated. So it's when was the business started, when was it incorporated. Now that date doesn't always match box A on the top left, which in this case is March 15, 1999. It's my birthday. March 15, not 1999. That's when this entity elected to become taxed as an S corporation. So, a lot of times people pick up box A and they think that's the start date of the entity, but this might have existed as a corporation beforehand. Pardon me?
So it did, because August 31st, 98 is when it was started.
Exactly.
So they didn't elect S corp until the next year.
Exactly. So the next box B is a business activity code. It's a NAICS code is what it's called. So this is done by the tax preparer, and it's really done for IRS classification and and research purposes. So in this case, if you go to the NAICS website and you pop in the number 442110, it'll let you know what industry this entity works, within. It's not always accurate. A lot of times it is accurate, but it's at the tax preparer's discretion. And we do see kind of frequently that we think that a NAICS code that we find is a little bit more appropriate than what's on the tax return itself, and that's okay. The next section, in the middle here, lines G through J, that's just sort of qualitative information about the business. So the first one to look at is really line H. That's going to let you know if this is the final tax return, if they change their name. Most importantly is actually number 4, if this is an amended return, because then you want to know why the tax return was amended. And if you have an amended return, you might want to ask for the original return also. And then also line I will let you know how many shareholders existed during the year. And I believe for S corporations, you can have between 1 and 100, but you can't have more than that. The next section is going to be the income section. That starts with line 1. We'll move this up a little bit. This is very similar to the income section on Schedule E that we just went through. It's the gross receipts or the revenue of the company, and that's how much sales or money that the company brought in before paying any expenses. It's the top line income. Then that's going to be reduced by the cost of goods sold, which there's an entirely separate form, 1125A, which Dave will touch on in a little bit. But that's essentially the cost of creating whatever the product was that was being sold, or if it's doing a service, what the cost of that labor was to provide that service. And after that, you get your resulting gross profit, which the tax return calls total income loss on line 6. From that number, in this case, $3,920,000, from your gross profit, you're going to pay operating expenses as any other business does. Okay, so in this case, this particular business paid $130,000 of compensation to officers. So there's a couple of things that are important about this line. First of all, this doesn't always have to be for one person. That $130,000 could be for multiple people. Having said that, we established a little while ago that this entity only has one shareholder. So you would expect the $130,000 to be paid to the one shareholder. But if there's multiple shareholders and the number is 200,000, it's possible that it's being paid 100,000 each, 150 to one and 50 to the other. There's a detailed schedule called 1125E that'll let you know what's going into line 7 compensation of officers. The rest of the expense categories are given by the IRS on form 1120S because they're the most common expense items: salaries and wages, repairs and maintenance, interest and advertising. These are things that are very commonly seen across any business, regardless of the type of entity that it is. For anything that's entity specific, they call them other deductions. And that goes to a totally separate statement that gets attached to the form 1120F. So what you would do is you would take your $1,076,000 that's on line 19 here, and you would have to flip through the tax return and look for statement 2. And statement 2 will give you another detailed listing of the expenses that all accumulate up to $1,076,000. Line 20 is the totality of all of the expenses starting from line 7 compensation of officers on down, your operating expenses. And line 21 is essentially line 6, which is your gross profit, minus line 20, which are your operating expenses, and you get your ordinary business income, not necessarily cash flow. And when we get to the K1, we'll explain a little bit more the difference between income and cash flow. But for anyone who's just picking up a business tax return, such as the Form 1120S, if you want to get a quick idea of how much how much this entity reported in total income to the owners, without having to do too much work, you can look at line 7, which is compensation to the owner, plus line 21, which is the resulting ordinary pass-through income to the owner, and get their total reported income from this entity, just like that. In this case, it would be the 419,000 rounded to 420, plus 130,000, which would be $550,000.
Just a couple of things to note. Line 6, sorry, Lou, is actually total income, because there's a little $5,000 of other income, so it's not gross profit.
Correct.
Gross profit actually is line 3. Just wanted to point that out. It's not a big deal, obviously. And you actually can be an officer without being an owner. So you do have to be careful sometimes. I know there's only one owner here. 95% of the time on a small business, this is going to be all the owners, but there are some times where we do see that it's an officer and not related. So you know, yes, the general is add those two, but there will be exceptions to that. And also, if a spouse is being paid through the business, it may or may not be on line 7. Sometimes it's in salaries and wages. So just be careful of that. Okay. The next thing we're going to look at is page 2, okay, of the 1120S, and there we go. Okay, so the first top of it is going to tell you, very important, what kind of accounting method it is. Is it cash? Is it accrual? Is it something else? Then line 2 is going to tell you what the business activity is. In this case, retail sales of antiques. If you had a car dealership, it would probably say auto, auto and then car dealership. Okay. Then there's some miscellaneous questions which are not too important. Here it'll tell you about changes in ownership of voting rights, if you have more than 20%. But a lot of times we don't see any of this filled out. And then there's just some more miscellaneous questions, which, not too important for purposes of what we're doing. We don't want to bore everybody and give you minutia. So we're going to move on from that to the next slide, which is your 1120S, which is page 4, which is your balance sheet. So this is an important one. Okay, so again, up top, it's just going to be, so up top is actually, there's a page in between called Schedule K. And this is just the income Schedule K. You'll notice it's fairly close to the amount that was on page 1, reported as income, 418,929. This is what is going to go to the K1. That's the exact number. But here, this is the balance sheet. So these are the assets less the liabilities that the company owns. So here you can see cash went up a fairly significant number. So you're going to want to know why. Did they not distribute the money for some reason? Were they, divorce planning? So they kept some of the cash in the business. That's something that we as valuators look for all the time. This will tell you the inventory, which in this case is the exact same number. So, something to keep, in the back of your mind. And what the other assets are, buildings and fixed assets and other depreciable assets goes here. Land, if they own a building, they're probably going to have land. So, that's something you want to look at. If the business has land, then it's probably going to own a building too, or just a piece of land, which is a piece of real estate you'll need to get valued in order to figure out what it's worth. Then there's the other assets, and you have the total assets. And then you have liabilities, which are, your accounts payable, your accrued expenses, any notes and mortgages that are payable, any other current liabilities, loans to shareholders, all of those things would go in there. Then you have your retained earnings. Here we have less cost of treasury stock. This is actually a buyback of somebody's stock at one point. Again, that's fairly complicated stuff. We don't have to get into it too deeply. If you have any questions on that, you can call us. And then these two numbers should tie out. So it should be your assets equal your liabilities plus your shareholders' equity. Okay, you'll see in both years it does tie out. Unfortunately, you'd be surprised how many times we see that it does not tie out. And then we have the second part of this. This form used to be all on one page, but this is your M1. Okay, this is a reconciliation of your income with your tax return to your books and records. So there are certain adjustments that are only for purposes of tax. Like depreciation might be different, 50% of meals and entertainment. You do not have to fill this out if you have, I think it's assets under $10 million. So a lot of times we will not see this filled out. It's not that they necessarily did anything wrong. There are requirements to fill it out. Sometimes if you don't meet it, it's not. And then the accumulated adjustments account, the bottom line, when you add all of these together, should equal your shareholders' equity. And it just tracks it from the beginning of the year to the end of the year. So things you might be looking for, other additions would be a capital contribution sometimes. Distributions, you want to know if they're making distributions, because we want to know if they did make distributions, if they had in the past, why they're not this year. So all of that information would go on your Schedule M2 and your Schedule M1. Then we have the cost of goods sold, which Lou talked about earlier. This would go back to page 1. So you start with your beginning inventory. You add your purchases. If you have cost of labor, 263A costs, again, some complicated stuff, not necessarily needed to talk about. Any other costs, and again, you'll see statements. So what might be in here, depreciation on real estate, or any other examples you can think of? Transportation, cost of labor is up top, so that's not going to be there, but things like that. And then you subtract out your ending inventory to get to this number. And this is the number that goes to your cost of goods sold, which at the end of the day would get from your sales less this is your gross profit. Okay. Moving on.
Okay. This is a Schedule K1. So this is going to be a very important document when comparing the business tax return to the Form 1040. And that's because Schedule K1, think of it as the instructions that are given to the tax preparer in order to file Form 1040 for the personal tax return. So this is a K1 for the Form 1120S. It's a little different for the Form 1065, which we'll get into in a little bit. But some information that you can get off of Schedule K1 is the name of the shareholder, which is going to be in box F right here in the center of your screen. Just above the shareholder's name is going to be, or actually just below, is going to be what that person's ownership percentage is. So in this case, they own 100% and the entirety of the S corporation. Over on the right here are some of the income reportable items. So box 1 is the most common one, especially for operating businesses. That's going to be ordinary business income, and that's going to flow through to your Schedule E. You can also add to that line 2, which is net rental real estate income. So if this is a real estate entity, instead of having ordinary business income, it would have net rental real estate income. All of this is giving the tax preparer just the information that gets reported on the personal tax return. Another important item to point out is Section 16D. And here the number is $262,870. This represents the actual distributions of, it's called distributions of property. 99 out of 100 times it's cash. So in this case, what's interesting is that they distributed out to the owner $262,000 of cash. However, the income for the business was greater at $419,000, as you see in box 1. There's a multitude of reasons why they wouldn't distribute out all of the income. They could be servicing debt. They could be buying more fixed assets. They can just keep the cash, in the bank account of the business for future growth and for operating purposes.
Right. The receivables could have gone up if it's an accrual basis. There's just so many different reasons that could happen.
Exactly. So it's just a distinction between income and cash flow. And it's important to understand why all of the income wasn't distributed, because when you're determining a spouse's income or cash flow for your case, you want to know what's actually being distributed to them, not necessarily just what their general income is. And you want to know the entire picture of it.
Okay, so now we're at Form 1065, which is a U.S. partnership income. So this again is a flow through. Okay, it's gonna eventually hit your Schedule K1, which will then hit your personal tax return. And it's very similar to the 1120 SD information on page 1. So you have what you do. Okay, this was on page 2 on 1120S. Now it's on page 1. You have the NAICS code that we talked about. Again, not necessarily correct. You have the name of the business, the address. You have the EIN number, when it was started. This is the total assets. If it's an initial return, a final return, if there's an address change, an amended return, what your accounting method is. Again, this was on page 2 on 1120S. Now it's on page 1. And then it's the same thing we saw. This is your income, less your cost of goods sold. Okay, and then here, we didn't even have a salary because there's no officer's compensation. It's actually called guaranteed payments to partners. And it would go in line 10. Okay, that eventually may or may not hit your K1, depending upon how they report it. But at the end of the day, you still have your, same expenses, rent, interest. There's a few less here than there are in the 1120S, and the rest of them would go into statement 2. And at the end of the day, when you take your income, your total income less your total expenses, you get your ordinary business income, in this case, $87,000. And down at the bottom, you'll have the accountant's information, which again, if you ever need to contact the accountant, that's a good thing to have. Okay, then we have the 1065, the K1 for the 1065. All right, and how is this different? Well, it still has your final and amended K1. So if it's final or if it's amended, it'll be checked. Okay, it still has all the same information of who the partnership was, who the owner is. But here, where we just had percentage interest, now we have profit and loss interest and also capital percentage interest. So this is what they would get from the profit or loss, and this is their ownership in the assets and liabilities. Okay, and at the bottom here, you have a reconciliation. So at the beginning of the year, the capital account was minus 226. Their percentage, their 37.5% of the income came to 32,778. They withdrew or distributed 26,250, which matches right here in box 18, is that 19? 19A. And then your ending capital of 6,302. So that's basically their portion of the capital left in the building or the equity left in the company. Okay. And then again, here, your ordinary business income and all the other, your interest, your dividends, all that stuff that's going to flow through to your personal tax return.
The last tax form that we'll share with you is Form 1120. Form 1120 is for C corporations. The difference with a Form 1120 is that the tax on the income is paid at the entity level. So what does that mean? For partnerships and S corporations that we just went through, the income is passed through to the owners, and the owners pay the tax on that income.
At personal tax rates.
At personal tax rates. For a C corporation on a Form 1120, the income is reported directly on this tax return and paid at the entity level. Now, if the entity pays out a dividend to the taxpayer, then that gets reported on Schedule B on the Form 1040, as we mentioned earlier, and the taxpayer pays the tax bill on just the dividend. So this creates what's called double taxation. You're paying tax on the income at the entity level, then that income is being distributed in the form of a dividend, and And on that same income, the taxpayer is paying tax on the dividend. So that's why C corporations are not, the most attractive. They're attractive from other perspective insofar that they can have different types of stock that they issue, preferred stock, common stock, different series of stock. A lot of times, C corporations are used for startup entities because they can do rounds of financing, and also C corporations allow an unlimited amount of stockholders, and that's why publicly traded companies such as Apple and Amazon, those are actually C corporations. So down at the bottom is where you can sort of see that activity where it's calculating the total tax on line 31, and then it goes on to calculate, if there's a tax payment that's due, if there's any amount that is going to be refunded. So with that said,
or applied to next year.
Or applied to next year. With that being said,
Hey, Lou, we just have a question.
oh,
Yeah,
let's do it.
Do you want me to read it?
yes,
Please do.
please.
Sure. To what extent does an owner in an S corp filing have to take a certain amount of income in the nature of compensation rather than as a distribution?
All right, so there are rules for that. Very often they're not followed. Okay,
Right.
so what do they need to do versus what they do are totally separate. I don't know the exact rule anymore because it changes. We can get that information to you. So Sammy, if you could take note of who asked that, we'll get them that information.
Sure, will do.
And the last thing, the poll that we took, it looks like 67% of you, wow, out of 51 votes, we got a good amount of votes there. 67% of you think that the winner will be the,
Kansas City Chiefs, again.
again, yep.
Well, thank you for joining us. We hope you both enjoyed it and learned something. And we look forward to presenting the next one when are we doing the next one? Do we
The
know?
next one's going to be in April. Look out for the email topic to be disclosed at a later date.
Thank you very much, everyone. Have a good day.